After 60, financial priorities shift from aggressive accumulation to sustainable income generation. The objective is not to win a short-term race, but to design a financial system that produces reliable cash flow every day without requiring constant supervision. In this stage of life, the emphasis moves toward preserving capital while ensuring that money continues to work independently in the background. One of the most effective methods for achieving this is building a portfolio centered on dividend-paying investments. Dividends are not arbitrary bonuses. They represent a proportional share of a company's profits distributed to its shareholders. Owning shares in multiple dividend-paying companies is equivalent to having thousands of small, productive enterprises around the world working on your behalf and sending you a portion of their earnings on a regular basis. The businesses capable of paying dividends consistently while continuing to grow often share common traits. They have durable operating models, loyal customer bases, prudent financial management, and leadership teams that prioritize long-term shareholder value. These qualities reduce the likelihood of disruption and enhance the stability of the income stream. Living off dividends offers a structural advantage over selling shares to generate cash. Selling assets reduces ownership and can deplete capital over time, particularly during market downturns. Dividends, on the other hand, allow investors to maintain their ownership stakes while still generating income, ensuring that the underlying capital continues to produce returns. For those entering or already in retirement, dividends can serve as the engine that powers financial freedom. The right portfolio of dividend-paying companies can deliver consistent income, increase payouts over time to outpace inflation, and remove the need to take on unnecessary risks to sustain one's lifestyle. This combination of stability, growth, and simplicity makes dividend investing one of the most effective strategies for long-term financial independence after 60. Before building a portfolio to live off dividends, it is essential to understand exactly what dividends are, how they work, and why they can serve as the foundation of a retirement income plan. A dividend is a direct distribution of a company's profits to its shareholders. It can be paid in cash, which is the most common form, or in additional shares of the company's stock. Either way, the payment is a tangible return on ownership. When an investor buys shares in a dividend-paying company, they are acquiring more than just a fluctuating number on a brokerage account statement. They are purchasing a fractional share of the company's capacity to generate cash and its commitment to sharing those profits with its owners. In this sense, a dividend is the investor's portion of the earnings created by that business's operations. Dividend-paying companies are often mature businesses with established markets, stable revenue streams, and a proven track record of profitability. This does not mean they lack growth potential. It means they have reached a point where they can allocate capital toward both expanding their business and rewarding shareholders. This dual capacity is a sign of financial health and operational resilience. One of the critical advantages of dividends is their independence from market prices in the short term. While share prices can fluctuate daily, dividend payments are typically guided by long-term profitability and are less volatile. A well-managed company aims to maintain or grow its dividend even during market downturns, providing a steady income regardless of temporary declines in share value. It is also important to understand the concept of dividend growth. Many companies increase their payouts regularly, sometimes annually, as their earnings grow. This creates a compounding effect. Not only does the investor continue to receive income, but that income rises over time, often outpacing inflation. This protects purchasing power and provides financial security without the need to constantly adjust investment strategies. Finally, understanding dividends means recognizing that they are not guaranteed. They depend on the company's profitability and financial discipline. This is why careful selection of dividend-paying stocks is essential. Only companies with durable business models, prudent management, and strong balance sheets should form the core of a dividend-based retirement plan. Dividends are a uniquely effective strategy for generating income in the later stages of life because they align perfectly with the financial priorities that emerge after 60: stability, predictability, and preservation of capital. At this point, the goal is no longer to take high-risk bets in search of maximum short-term returns, but to ensure that a portfolio produces steady income without depleting its underlying value. Unlike selling shares to fund expenses, which reduces ownership and can permanently erode a portfolio's earning power, dividend payments allow investors to retain their equity stakes. The shares remain intact, continuing to generate income while the cash flow arrives on a regular schedule. This creates a sustainable income stream that does not require ongoing market transactions. Dividend income is also less emotionally stressful during market downturns. Share prices can fluctuate dramatically in the short term, but many well-managed companies maintain or even increase their dividends regardless of market volatility. This means that while the value of the portfolio on paper might temporarily decline, the income it generates can remain stable, providing peace of mind and financial continuity. Another advantage is inflation protection through dividend growth. Many established companies have a track record of raising their payouts over time, sometimes faster than the rate of inflation. For a retiree living on fixed income sources, this growth is critical. It means that purchasing power is maintained or even improved without the need to take on additional investment risk. Dividends also simplify withdrawal strategies. Instead of selling assets each month or quarter to meet living expenses, retirees can structure their portfolios so that dividend income covers most or all of their regular needs. This reduces transaction costs, lowers tax complexity in some jurisdictions, and minimizes the risk of selling investments at an inopportune time. Finally, dividends foster a disciplined, long-term investment approach. Because the focus is on owning quality businesses that generate consistent profits, dividend investors are less likely to chase speculative opportunities or overreact to short-term market events. This discipline aligns perfectly with the mindset needed to protect and grow wealth during retirement. The success of a dividend-based retirement plan depends heavily on the quality of the companies selected. Not all dividend payers are equal, and focusing solely on high yields can be a costly mistake. The objective after 60 is not to chase the largest possible payout in the short term, but to build a reliable, growing stream of income supported by financially strong businesses. The first selection criterion is financial stability. Companies with strong balance sheets, low levels of debt relative to earnings, and consistent profitability are better positioned to sustain dividend payments through economic cycles. A high payout ratio, where a company distributes most of its profits as dividends, can be a red flag if it leaves little room for reinvestment or for maintaining the dividend during downturns. Earnings consistency is equally important. Businesses with stable, predictable cash flows, such as those in consumer staples, utilities, or healthcare, tend to maintain dividends more reliably than those in highly cyclical industries. This does not mean avoiding all cyclical companies, but it does require a careful assessment of how well they can weather periods of reduced revenue. Another key factor is dividend growth history. Companies with a track record of raising their dividends annually, sometimes for decades, demonstrate both profitability and management's commitment to rewarding shareholders. This historical consistency often signals a culture of financial discipline that extends into the future. Business durability must also be assessed. Companies that hold competitive advantages, whether through brand strength, unique intellectual property, high switching costs, or dominant market positions, are more likely to sustain and grow their earnings. This long-term resilience supports not just stable dividends, but also potential capital appreciation. Finally, valuation matters. Even a high-quality dividend stock can be a poor investment if purchased at an excessive price. Careful analysis ensures that shares are acquired at reasonable valuations, balancing income generation with the potential for growth and minimizing downside risk. By combining these criteria, financial strength, earnings stability, consistent dividend growth, business durability, and fair valuation, investors can construct a portfolio designed to deliver sustainable income well into retirement. This disciplined approach ensures that dividends serve as a dependable financial engine rather than a fragile source of cash flow. Designing a dividend portfolio after 60 requires more than simply owning a collection of high-yield stocks. It involves deliberate construction to balance income stability, growth potential, and risk management. The aim is to create a diversified set of income-producing assets that can weather market fluctuations while delivering consistent cash flow. The first step is diversification across sectors and industries. Concentrating too heavily in one area, such as utilities, real estate, or energy, can expose the portfolio to sector-specific risks. By spreading investments across industries like healthcare, consumer goods, technology, finance, and industrials, the income stream becomes less dependent on the fortunes of any single market segment. Geographic diversification is another important layer. While domestic dividend stocks may form the core of the portfolio, including international companies can provide exposure to different economic cycles, currencies, and growth opportunities. This reduces the impact of local downturns and broadens the sources of income. The portfolio should include a mix of high yield, moderate yield, and dividend growth stocks. High yield stocks provide immediate cash flow, moderate yield stocks balance income and growth, and dividend growth stocks may start with lower payouts but have the potential to increase them substantially over time. This combination ensures that the portfolio can generate sufficient income today while still keeping pace with inflation in the years ahead. An often overlooked element is position sizing. No single stock should represent too large a portion of the portfolio, even if it appears exceptionally strong. Overconcentration magnifies risk. If that company experiences financial difficulty or cuts its dividend, setting maximum allocation limits for individual holdings helps preserve overall stability. Reinvestment strategy also plays a role. In the early years of retirement, investors may choose to reinvest a portion of their dividends into additional shares, compounding their income potential. As the need for cash flow increases, reinvestment can be reduced or stopped, with dividends redirected to cover living expenses. Finally, the portfolio must be reviewed and adjusted regularly. While the focus is on long-term stability, business fundamentals, and market conditions do change. Regular monitoring ensures that underperforming companies are replaced, overvalued holdings are trimmed, and the overall income stream remains secure. A well-structured dividend portfolio acts like a self-sustaining financial engine, producing consistent income, adapting to economic conditions, and preserving the capital base so it can continue working indefinitely. One of the most significant threats to retirement income is inflation, the gradual erosion of purchasing power over time. For individuals over 60 whose income may rely heavily on fixed sources, even moderate inflation can have a compounding negative effect. Dividend growth investing is one of the most effective tools for countering this challenge. Dividend growth refers to companies that regularly increase the amount they pay to shareholders. Unlike fixed income investments, which provide the same payment year after year, dividend growth stocks can raise their payouts to match or exceed inflation rates. This means that the income stream not only remains steady in real terms, but can actually improve over time. Historically, many of the most reliable dividend growth companies, often referred to as dividend aristocrats, have increased their dividends annually for decades through various economic cycles. This consistency signals both operational strength and a shareholder-focused management philosophy. The impact of dividend growth compounds over long periods. For example, an investor receiving $20,000 in annual dividends from a portfolio that grows payouts by 6% per year will see that income rise to over $32,000 in just 10 years without adding a single new dollar of capital. This organic growth reduces dependence on asset sales and allows the portfolio to cover rising living costs without additional risk-taking. Companies capable of consistent dividend growth typically have several traits in common: durable competitive advantages, strong free cash flow generation, prudent debt management, and the ability to pass on price increases to customers. These qualities not only support dividend increases, but also make the business more resilient in economic downturns. For retirees, the combination of current income and future income growth is essential. High-yield stocks may provide more cash today, but without growth, their real value erodes over time. Dividend growth stocks, even with moderate starting yields, can ultimately provide more income in later years while preserving or increasing the value of the underlying capital. Integrating dividend growth into a retirement portfolio ensures that the income stream keeps pace with inflation, maintaining financial independence and stability for decades. One of the most common mistakes in dividend investing, especially for those seeking income after 60, is chasing the highest possible yields without assessing their sustainability. A yield that appears unusually high can be a sign of underlying problems within the company, and relying on such payouts can expose a retirement portfolio to unnecessary risk. A dividend trap occurs when a company offers a very high yield because its share price has dropped significantly, often due to declining earnings, competitive pressures, or structural challenges in its industry. While the high yield may seem attractive, the market is often signaling that the dividend is at risk of being reduced or eliminated. To avoid these traps, investors should look beyond the yield percentage and analyze the payout ratio, the proportion of earnings or free cash flow used to pay dividends. A payout ratio consistently above 80 to 90% can indicate that the company has little flexibility to reinvest in its business or maintain the dividend during downturns. A healthy range is often between 40% and 70%, depending on the industry. Cash flow analysis is equally critical. Dividends are ultimately paid from cash, not accounting profits. Companies that consistently generate strong free cash flow relative to their dividend obligations are better positioned to sustain and grow payouts over time. Another warning sign is excessive debt. Highly leveraged companies face greater financial strain during economic slowdowns, which can force dividend cuts even if current earnings appear sufficient. Monitoring debt levels alongside interest coverage ratios provides insight into a company's financial resilience. Investors should also consider industry stability. Some sectors, like utilities or consumer staples, have relatively predictable earnings and dividend histories. Others, such as energy or commodity-based businesses, can experience wide swings in profitability, increasing the risk of dividend reductions. Finally, diversification plays a key role in avoiding traps. By spreading investments across multiple sectors and companies, the negative impact of a single dividend cut is minimized. Avoiding unsustainable yields is about discipline and long-term thinking. A steady, growing dividend from a financially sound company is far more valuable than a temporary high yield that collapses under financial pressure. For retirees, stability and reliability must always take precedence over short-term allure. For individuals over 60, dividend income rarely exists in isolation. It is most effective when integrated into a broader income strategy that includes other reliable sources, such as pensions, Social Security benefits, annuities, or rental income. The goal is to create a diversified set of income streams that collectively provide stability, growth, and resilience against unforeseen changes. The first step in integration is mapping all predictable income sources. For many retirees, Social Security or pension payments form the foundation, covering essential living expenses like housing, food, and utilities. Dividends can then be layered on top of these guaranteed sources to enhance lifestyle quality, fund discretionary spending, or provide for travel, hobbies, and charitable giving. This layered approach serves an important risk management function. If dividend income temporarily declines due to a company's reduced payout or broader market conditions, core expenses are still covered by guaranteed or contractually fixed income sources. This prevents the need to sell assets at unfavorable times to meet basic needs. Dividend income can also be coordinated with tax planning strategies. Depending on the jurisdiction, qualified dividends may be taxed at lower rates than ordinary income, making them more tax efficient than some other forms of cash flow. Careful planning can help manage withdrawal sequences, drawing first from taxable accounts, then from tax-deferred accounts to minimize overall lifetime tax liability. Reinvestment flexibility is another advantage of integrating dividends into a larger income plan. In years when dividends exceed living expenses, the surplus can be reinvested into additional dividend-paying assets, compounding future income. In leaner years, the full amount can be taken as cash without disrupting the rest of the portfolio. Finally, integration ensures that the income plan remains adaptable over decades. As personal needs change, whether due to health, lifestyle shifts, or family priorities, the mix of income sources can be adjusted. Dividends might take a larger role if guaranteed income is fixed, or they might be supplemented by part-time work, consulting, or other active income sources. By weaving dividends into a comprehensive retirement income framework, retirees can create a more resilient and flexible financial system, one that sustains quality of life and protects against the inevitable changes that come with time. Even the most carefully constructed dividend portfolio is not without risk. Market fluctuations, economic downturns, and company-specific challenges can all impact income levels. For retirees over 60, the objective is not to eliminate risk entirely, something that is impossible, but to manage it in a way that preserves both income stability and capital longevity. The first and most fundamental risk control is diversification. No single company, sector, or region should account for an outsized portion of income. A balanced portfolio might include holdings across multiple industries such as healthcare, consumer goods, technology, finance, and utilities, as well as exposure to both domestic and international markets. This broad spread reduces the likelihood that a single negative event will significantly disrupt income. Quality screening is equally important. Dividend investors should prioritize companies with strong balance sheets, consistent free cash flow, and a history of maintaining or increasing dividends through multiple market cycles. Businesses with durable competitive advantages like dominant market share, valuable patents, or high customer loyalty are better positioned to sustain payouts even in adverse conditions. Another layer of protection is maintaining a cash reserve or short-term bond ladder equivalent to 1 to 2 years of living expenses. This buffer allows retirees to cover expenses without selling equities during market downturns, giving dividend-paying holdings time to recover before being relied upon again for full income needs. Monitoring payout sustainability is an ongoing process. While initial research might identify strong candidates, company fundamentals can change over time. Regularly reviewing financial statements, payout ratios, and earnings trends ensures that any deterioration is identified early, allowing for adjustments before a dividend cut occurs. Interest rate risk must also be considered. Rising rates can affect certain dividend-paying sectors, such as real estate investment trusts, REITs, or utilities, by increasing borrowing costs and reducing relative yield appeal. Diversification across sectors with varying sensitivity to interest rates helps mitigate this exposure. Finally, a disciplined rebalancing schedule ensures that no part of the portfolio becomes disproportionately risky over time. Trimming overweight positions and reinvesting in underrepresented areas keeps the risk profile aligned with the original plan. Risk in dividend investing cannot be eliminated, but with a thoughtful structure, ongoing oversight, and protective buffers, it can be managed to a level that supports a secure and predictable retirement income. A dividend-focused retirement plan is not a static arrangement. Even after 60, the goal should be not only to preserve income, but to expand it, ensuring that purchasing power and lifestyle quality are maintained over the long term. Sustaining and growing dividend income requires a combination of strategic selection, ongoing monitoring, and disciplined reinvestment. The foundation of long-term success is continuous portfolio quality management. This means holding companies that have proven their ability to generate steady profits, protect margins, and increase payouts year after year. Businesses with strong competitive moats, such as recognized brands, proprietary technologies, or essential services, are more likely to maintain resilience through economic cycles. Dividend reinvestment plays a crucial role, particularly in the earlier years of retirement or during periods when income exceeds spending needs. By automatically reinvesting dividends into additional shares of high-quality companies, investors harness the power of compounding, which can significantly increase future income without additional contributions of capital. A proactive approach to inflation protection is also vital. Even moderate inflation can erode the value of a fixed income stream over time. Prioritizing companies with a history of dividend growth, ideally outpacing inflation, ensures that income rises alongside or faster than costs of living. Regular reviews and adjustments help maintain portfolio health. Economic conditions change, industries evolve, and even strong companies can face challenges that affect their ability to pay dividends. Periodic assessments allow investors to identify and replace underperformers while reallocating capital towards stronger opportunities. Flexibility in income distribution strategy is another key factor. In years when dividend income exceeds needs, surplus cash can be reinvested for future growth. In leaner years, the income can be fully drawn without disrupting capital. This adaptability allows the portfolio to serve as both a reliable paycheck and a self-sustaining growth engine. Finally, maintaining a long-term mindset ensures stability through market volatility. Dividend investors who focus on the health of their income stream rather than short-term stock price movements are better positioned to avoid panic selling and stay committed to their strategy. Over decades, this disciplined approach transforms a dividend portfolio from a simple source of income into a durable financial system, one that continues to deliver stability, growth, and security throughout retirement and beyond. If you've liked the video, don't forget to subscribe to not lose on any of the tips to manage your wealth over 60.